CFOs and CMOs really have three things in common. First and foremost, they are under intense pressure to deliver sustainable financial results both in the near term and in the longer term. Secondly, these two C-level executives are the ones that are most under pressure from a tenure perspective, with an average tenure of between 24 and 36 months, depending on which. And the last part is really in terms of getting a return on the investment that they're making in assets. And when I say assets, it's both tangible assets, such as net property, plant and equipment, inventory, etc., and intangible assets, which are things like the customer, brand, loyalty, intellectual capital, and things like that. In 1980, if you invested $1 in an S&P 500 stock, 80 cents of it would be on the balance sheet in terms of hard assets. Today that is 25 cents on the balance sheet in hard assets, which means that 75 cents or 75% of the value of an S&P 500 company today is driven by intangible assets, or driven by the customer loyalty, the brand, or indeed the intellectual capital. As such, it presents a greater challenge for CFOs and CMOs to really figure out where they're making investments in these assets and what kinds of returns they are getting, both in the near term and the longer term. We have found that measuring non-financial information is a critical differentiator for high-performing companies. In fact, when we did a research study a few years back, over 120 companies across 30 different industries, we found that 95% of executives said that measurement of intangibles and non-financial information was a critical enabler of their strategy, yet only 5% felt that they had robust measurement systems in place. The first element of figuring this out is really to understand what drives value for a company, what drives value consistent with execution of its strategy. That is not an easy thing to do. In fact, in many companies, that is the secret sauce in terms of figuring out what are the critical drivers of value for these companies. Secondly, companies today, the ones that are really figuring this out and are the high performers, are in fact using this as a competitive advantage, whereby they are figuring out analytically what drives their strategy, as opposed to looking at multiple different things from a non-financial perspective. As such, it's critically important for CFOs to understand across all the data that they could potentially measure what's most critically important that drives execution of their strategy. The challenge with understanding what are the key experience drivers from a customer perspective that most influence financial performance is one that is a non-trivial challenge for most companies to address. In fact, the key here is really getting to actionable insight, not just data, but insight. In working with an airline company in Europe a few years ago, they were looking at what drove their customer experience. And the important thing to think about here is that correlation is not causation. So what I mean by that is, in this case, they found an interesting correlation between customer satisfaction and late departures of aircraft, which was rather interesting and not intuitive, so we could try to get underneath that to understand what was actually happening. And when we did that, we found that the actual customer experience was better when flights were leaving late, because the in-flight cabin crew did a better job of engaging the customers to drive a better experience. So the key question for that airline was, how do you actually incent and motivate that kind of behavior with the in-flight cabin crew all of the time? Another example of that specifically is to look at it through a customer lens on your business. So a grocery client that we worked with actually typically looked at their assortment through a product-centric lens. So they'd say which products are profitable and which ones are not. So from this particular example, they were analyzing their assortment that said that a balsamic vinegar was not a profitable SKU and was not moving rapidly, and they considered removing it from the assortment. However, when we suggested them to look at that problem through a customer lens, they actually found that what that product was being bought with was the more expensive wines, the more expensive meats, etc. And as a result, that customer that was actually purchasing that product was probably their most profitable customer. So if they were to remove that SKU from the assortment, that customer would probably go elsewhere for that. And even though they may only buy that particular product 2 or 3 times a year, they buy their meats and wines every week. So looking at the problem through a different lens actually was the key to this particular grocery business making a substantive change in how they operated and measured their business around the customer. As we think think about CFOs and CMOs speaking different languages, it's really motivated by what is their primary focus. And there is that natural tension between the marketing and finance sides of the business. The CMO's primary goal is to drive the customer brand, the overall customer experience and growth, which tends to be a longer term time horizon. Whereas the CFO, in addition to being the chief driver of the strategy and custodian of the numbers, is also responsible for hitting quarterly financial results for most public companies. So as such, in many cases, what the CMO is trying to do and trying to drive from a customer experience perspective and what the CFO is trying to drive from a financial performance perspective can tend to be at odds, and there's a natural tension there that actually causes them to get out of line. And when it comes down to actually talking the common language, in many cases the CMOs and marketing organizations don't have robust measurement around the things that are most important to drive the customer experience, and as such they struggle with making their case to the CFO to make investments in the brand, to make investments in customer loyalty, to make investments in the employee training to drive a better customer experience. And as such, they are the first things that tend to be cut when there's pressure from a financial perspective, especially in current economic times going into something of a slowdown in the US economy. The paths of CFOs and CMOs have rarely crossed in the past because in the past most companies' results were driven primarily off of hard tangible assets. Today the majority of a company's value is driven off of intangible assets, and those assets start with the customers. They start with the brand, they start with customer loyalty, etc. So as a result, by definition, for these companies that are going to be high performers, they've got to determine where they make investments in specific customer strategies and what exactly that will result in terms of revenue uplift, margin, and indeed return on capital. These are the things that the high performing companies are able to do really well. In fact, a specific retail client of ours set a goal of doubling the value of their enterprise over 5 years. They found that in talking and doing market research and doing a quantitative fact-based analysis of where their strategies should focus, that they needed to focus on simplifying the customer experience and the overall shopping experience. And they did that by really rebranding the entire experience around this simplifying message, and indeed delivering a lot of their private label products and reorganizing their stores to simplify the shopping experience, and also improving the integration between their multiple different channels, be it online, over the phone, or in the store, all felt the same way. And as a result, they were able to tie together the specific investments that they made and then the measurement of those investments over time, so that they were able to make course corrections when the uplift in revenue and profitability may not have been on target.